Understanding Capital Gain Bonds, a comprehensive guide to Section 54 EC. Welcome to StockRhino. If you've sold a property and made a good profit, the next question usually is, how much tax will I pay? But what if we told you that you could legally save that tax and still earn steady returns? That's where capital gain bonds, also known as 54 EC bonds, come in. In this video, we'll explain what they are, how they work, and how you can use them to reduce your capital gains tax. What are capital gain bonds? Capital gain bonds are special government-backed bonds that let you reinvest profits from the sale of property or land and avoid paying long-term capital gains tax. These bonds are issued by government institutions like NHAI, REC, PFC, and IRFC, making them one of the safest investment options available. Why these bonds exist? The idea behind these bonds is simple. You save tax, and your investment helps fund India's infrastructure projects, from highways and power grids to railways. So, while you reduce your tax outflow, your money helps build the nation. Who can invest? Any Indian resident who has earned long-term capital gains from selling land, buildings, or property can invest in these bonds. They are open to individuals, HUFs, Hindu undivided families, companies and firms. The key rule: you must invest within 6 months of the sale to claim the tax exemption. Main features. Section 54 EC of the Income Tax Act allows this tax exemption. Lock-in period: 5 years, you can't sell or transfer them before that. Interest rate: around 5% to 5.75% per annum, paid yearly. Maximum investment: 50 lakh per financial year. Minimum investment: usually 10,000. Safe, issued by government-backed institutions. Available both offline and online in demat form. How to invest? You can invest in these bonds by visiting the official websites of NHAI, REC, PFC, or IRFC. Applying through designated banks or brokers. Submitting basic KYC documents. Once processed, you'll receive your bond certificate, or it'll reflect in your demat account. Tax benefits. The amount you invest in these bonds is exempt from capital gains tax. You can invest up to 50 lakh in one financial year. But if your gain is more, say 80 lakh, and you only invest 50 lakh, tax will apply on the remaining 30 lakh. Interest earned on the bonds is taxable, but your main exemption benefit stays intact. Benefits. Benefits of capital gain bonds include 100% exemption on capital gains tax. Safe and government-backed. Predictable fixed annual interest. Suitable for conservative or retired investors. Helps in long-term wealth preservation while reducing tax liability. Limitations. But there are some limitations. You can't sell or transfer them for 5 years, they're fully locked in. Interest rates are lower than regular fixed deposits or corporate bonds. Interest is taxable each year. Only gains from land or building sales qualify, not stocks, gold, or mutual funds. Current issuers. Currently, these bonds are issued by 4 main government-backed organizations. NHAI, National Highways Authority of India. REC, Rural Electrification Corporation. PFC, Power Finance Corporation. IRFC, Indian Railway Finance Corporation. All 4 are trusted public sector enterprises, making these bonds among the safest tax-saving instruments. Smart tips for investors. Smart tips before investing. Invest within 6 months from the sale date, don't delay. Don't exceed 50 lakh total investment in one financial year. Always check the issuer's latest interest rate and application window. Keep your bond certificate and PAN details safe for tax filing. Consult a tax advisor if you've sold multiple assets in 1 year. Ideal for. Capital gain bonds are ideal for property owners looking to save tax after sale, senior citizens seeking safe, fixed returns, businesses selling land or commercial assets, conservative investors prioritizing security over returns.
Want to learn more? Visit our website